Hi guys, it's Stock Curry, and the largest bank collapse in 15 years, bigger than SVB, is happening right now. Also, the Fed meeting is happening this week, and Apple earnings are coming out this week. We're going to talk about all of it, so let's get into it. The largest bank collapse in 15 years is happening right now. This bank collapse is bigger than Silicon Valley Bank. It is now the second largest bank collapse in U.S. history, and that is First Republic Bank. First Republic is most likely headed for FDIC receivership. The stock was down 43% on Friday and another 33% after hours. Big banks, including JP Chase, Bank of America, and others, have been asked for final bids on First Republic. U.S. regulators have asked banks for their best and final takeover offers for First Republic by Sunday afternoon, in a move that authorities hope will calm markets and cap a period of uncertainty for regional lenders. JP Chase and PNC are the most likely bidders. If regulators, led by the FDIC, receive an acceptable offer by Sunday, it's possible that a new First Republic owner could be announced as early as Monday. First Republic's advisors had hoped to avoid a government takeover by persuading the biggest U.S. banks to help once again, but ultimately the banks wouldn't bite on this last-ditch effort, leaving the government poised to end First Republic's 38-year run. Now, despite the possible FDIC collapse, the stock market has been largely unfazed by this news. It appears that the stock market kind of got over the banking crisis from 2 months ago, and the stock market appears to just feel like, well, this is just the last of the banks to collapse from the crisis 2 months ago, and everything else from here on out is going to be fine. But a lot of people are warning that that is not actually the case, and that most banks are still in a lot of trouble. Charlie Munger warned of trouble for the U.S. commercial property market, which in turn could cause more banks to collapse. According to an article in the Financial Times, Charlie Munger has warned of a brewing storm in the U.S. commercial property market, with banks full of what he said were bad loans as property prices fall. The country's financial system is reckoning with a potential commercial property crash following a handful of bank failures. While it's not nearly as bad as it was in 2008, trouble happens to banking just like trouble happens everywhere else. In the good times, you get into bad habits, and when bad times come, the banks lose too much money. Munger said a lot of real estate isn't so good anymore. We have a lot of troubled office buildings, a lot of troubled shopping centers, a lot of troubled other properties, and there's a lot of agony out there. He noted the banks were already pulling back from lending to commercial developers because they all seem to be in too much trouble. Of course, Munger isn't the first person to warn of the commercial banking crisis causing an overall banking collapse and more bank failures. There are many other people who have warned about this, and we've talked about it many times on this channel. But coming from somebody who has been extremely invested in banks over his career, Charlie Munger and Warren Buffett are generally believed to be some of the people who have some of the greatest insight into the banking sector. So for him to say that a commercial property crisis is on the horizon and could cause more bank collapses really holds a lot of weight. Now, Munger also had a warning to investors. He warned that the golden age for investing was over, and investors would need to contend with a period of lower returns. Munger said it's gotten very tough to have anything like the returns that we've obtained in the past. He pointed to higher interest rates and a crowded field of investors chasing bargains as the reasons why high gains would be very difficult in the future. And if you're looking at all of this and just waiting for the stock market to crash and this major recession to come, well, you might have to wait a little bit longer than you thought. And that's because the building boom is prolonging the market pain. The building boom has helped push unemployment to around its lowest level in more than 50 years. Construction spending and employment have risen to new records this year, boosted by government outlays for infrastructure, a domestic manufacturing renaissance, and a wave of apartment buildings that got off to a slow start during the pandemic when prices for building materials such as lumber were sky high. Construction companies say they have enough work booked to maintain payrolls for years in some cases. And the strong labor market has caused investors to trade government bonds as if rate cuts will come within the next year, as well as buy technology stocks, Bitcoin, and other speculative assets that surged when borrowing costs were near zero. The issue for investors is that the longer it takes for construction activity and employment to decline, the longer it will be before the central bank can cut rates. And we'll get some insight into what the Federal Reserve plans to do in the future in just a few short days, as Tuesday and Wednesday is the May FOMC meeting. This coincides with a very busy week full of economic data that will absolutely move the market throughout the entire week. On Monday, we get things started with the ISM manufacturing data as well as construction spending. Then on Tuesday, we get U.S. job openings for March as well as factory orders for March. Both of those come out while the market is open. Then Wednesday morning is going to be huge. We get the ADP employment private payrolls in the morning before the market opens. Then we get the ISM services index while the market is open. Then about 2 hours before the market closes, we get the FOMC decision on how much they're going to raise interest rates by. Then 30 minutes after that, we get Federal Chair Powell's press conference, where we will get a little bit more information as far as what they plan to do in the future and whether or not these rate cuts that investors are pricing in may or may not actually happen. And it doesn't end there, because Thursday we get U.S. productivity as well as the U.S. trade deficit for March, as well as initial jobless claims for the week. Then on Friday, we get the official labor market numbers, including U.S. unemployment report, the unemployment rate, the U.S. hourly wages, and the hourly wages year over year. So this week is going to be a jam-packed week full of economic data. And while the Federal Reserve meeting might be the biggest market mover, it will not be the only market mover. And there is major economic data coming out every single day this week that will absolutely move the markets. But for a minute, I want to get back to the Federal Reserve and talk a little bit more about where we expect the Federal Reserve to go with their interest rate hikes. The market is widely pricing in with an 85% chance that the Federal Reserve will do a 25 basis point rate hike, that is a 0.25% rate hike on Wednesday. Now, the market is pricing in a 15% chance of the Fed pausing, meaning that if the Fed does go through with their 25 basis point rate hike, this could cause a small decrease in the market. But ultimately, I think the market reaction is going to depend upon what the Federal Reserve says during their press conference at 2:30 Eastern. And looking forward into the future FOMC meetings throughout the rest of the year, the recent stock market calm has rekindled debate over the possibility of the Fed tightening more. Back when I lived in the hood, whenever things would get quiet and there was nobody walking around on the streets, the people who were out and about, nobody was talking, you knew something bad was about to go down. And likewise, for some investors, the stock market is almost too quiet. Volatility has subsided to its lowest level since 2021, and that is despite this year's hikes, expectations for another 25 basis point rate increase, and worries that turmoil in regional banks will slow lending and contract the economy. Of course, several factors have suppressed the market swings. Those include a surprising strength in jobs and consumer spending, as well as robust earnings reports from a few key tech companies, and data showing that overall inflation has cooled. But below the surface, some also point to another factor that has kept the stock market propped up, and that is the Federal Reserve's balance sheet, which is loaded with bonds purchased to support the economy during the banking crisis, and that might be insulating Wall Street from the effects of rising interest rates. Growth has slowed, but inflation remains persistent in key areas, raising concerns that the balance sheet could force the Fed to take rates even higher, prolonging the pain in the markets. Traders expect the Fed to cut rates twice later this year, but Fed officials have pushed back on that notion, emphasizing that rates will stay restrictive. One possibility that, if it comes true, would absolutely crash the markets would be if Jerome Powell on Wednesday says not only are we raising interest rates by 25 basis points in May, but we are considering not pausing at the next FOMC meeting, and we're considering continuing to raise interest rates. If Jerome Powell comes out and says that, which he very well may, given the strength of the labor market, that could absolutely crash the stock market. If, on the other hand, Jerome Powell comes out and says, we are looking at probably pausing and we're going to expect to keep our rates at this elevated rate through the end of this year, I would expect the stock market to most likely rally because, one, the stock market is looking for the Federal Reserve to say they're pausing, and that could cause a rally. Two, the stock market won't believe Jerome Powell that they will actually keep rates elevated. If the stock market's currently pricing in Jerome Powell cutting rates twice this year, why would they believe him now when nothing has really changed that much in the economy? So that's why, if Jerome Powell gives an indication that pausing is more likely at the next meeting, I expect the stock markets to rally. But if Jerome Powell gives the indication that they might continue to raise interest rates, I would expect the stock market to sell off. Of course, all of this economic news, including the FOMC meeting, isn't the only thing that's going to move markets this week, because we also have earnings. And boy, oh boy, do we have some big companies reporting earnings this week. We get things started Monday morning with SoFi and Norwegian Cruise Lines. And then Tuesday before the open, we've got Uber and Pfizer. Then Tuesday after the close, we start getting into some bigger market movers such as AMD and Ford. Wednesday before the open, we've got CVS Health and Yum Brands. And then after the close, we got Qualcomm. Now, after the close, I think the market is still going to mainly trade based upon the FOMC meeting, as well as going into Thursday morning. I think we'll continue to trade based upon the FOMC meeting, but then everything is going to change Thursday after the close, because that is the big, big earnings day. We have Apple, Shopify, Block, Coinbase, DraftKings, Lyft, you name it. They're all reporting Thursday after the close. And this is going to be a massive market mover for the markets on Friday. But it doesn't all end Friday, because Friday we've also got AMC. And I know a lot of retail investors are excited about this one. Now, regarding my predictions for Apple earnings, I would expect Apple stock to absolutely skyrocket after their earnings. And I don't even think it matters if they beat earnings or not. Last quarter, Apple had one of their worst quarters in a decade. It was absolutely terrible, horrible, horrible earnings, and the stock skyrocketed. They missed earnings on both lines. It was a disaster, and yet the stock market skyrocketed. So I really don't think earnings even matter at all on Apple. I just think the stock is going to skyrocket no matter what, because why not? People are buying tech companies for the heck of it. Might as well keep buying them regardless of earnings. So that's what I think is going to happen with Apple. I think it's going to skyrocket no matter what the earnings come out as. Now, the other companies are probably going to trade more in line with however earnings expectations come out. Intel had Intel actually had their worst quarter on history. Tesla also had a terrible quarter, while other companies like Microsoft and Amazon and Alphabet all had great quarters. So it's really, really hard to determine just how a lot of the tech companies on Thursday are actually going to report because it's been very mixed so far. That said, this week is also big because we start getting into some other sectors that are a little bit heavier in the Dow and the S&P, such as a lot of retail as well as some of the food chains. And we haven't really heard earnings from those companies yet. So this is going to be a really interesting week to get an idea of just how companies are doing on the broader overall economic range beyond just the tech sector. Of course, we also have to understand that even if companies like Apple beat earnings this quarter, longer term, companies are going to start coming into some headwinds over the next few quarters. As top cloud providers, Amazon, Microsoft, and Google, all on their earnings calls, as well as in their earnings reports, said that they face ongoing spending cuts by clients. And as companies continue to cut their spending, this is going to cause other companies to have to cut their spending, which in turn is going to cause layoffs and lower earnings reports. All of it will eventually lead to a recession, but trying to determine when that recession will actually occur is very difficult. The Federal Reserve, as well as many CFOs, believe the recession will start by the end of this year. But about half of CFOs still believe the recession won't start until 2024. So we know the stock market will sell off once a recession actually does start. But what the stock market does in the next 6 months to a year before then, that's really hard to tell. And we're just going to have to wait and see. The good news is we're going to have a lot of clarity on where we should expect the stock market to go over the next 3 months at least, based upon all of the economic data, the Apple earnings, the FOMC meeting. All of it should give us some very clear market direction this week. And if you want to learn how to make money no matter which way the market trades, if it goes up, down, or even trades sideways, come join us in my coaching program where I will teach you how to trade options, including multi-leg options, so that you can make money no matter which way the market goes. If you want more information on the coaching program, you can schedule a call with my onboarding specialist at weprofitdayandnight.com. That's weprofitdayandnight.com. And if you want to get the rest of the market news that I didn't have time to cover in this video, as well as the technical analysis for the week ahead, make sure you sign up for my free weekly newsletter and get all of the information that you need to know before the markets open on Monday. You can sign up for that free weekly newsletter at stockcurry.vip/newsletter. That's stockcurry.vip/newsletter. If you got a lot out of this video, then be a good friend and share this video on your social media pages so that others will know what's going on in the market as well. And don't forget to hit the like button and subscribe. And if you missed my last video where I covered Amazon earnings and explained more about what's going on in the stock market right now, make sure you watch the last video that I uploaded here.